Welcome to Key Stock and Crypto Channel.
And we have Jerome Powell in the house this week. And they're going to be raising rates, and we know what Jerome is going to say. They're going to be data dependent. Now, October, we get a reliever, but November and December, they're also going to be raising rates and running off the balance sheet. And we have Guggenheim Scott Minor says that the Fed raising rates will end in tears for stock investors. And guys, we know he's telling the truth. Remember what Blackstone stated? It's going to be 10 years with no growth. And right now, guys, we're going through hyper-deflation. And I know you ask, how are we going through hyper-deflation when we're in the process of inflation? Because right now, guys, because the Fed is raising rates and run off this balance sheet, we're not getting any growth. And you can look at all sectors, there's no growth. And I'm going to get into that later. Now, we had Biden on 60 Minutes says the pandemic is over. And, of course, the biotech stocks take a hit. But, guys, we know it's wintertime coming. People are definitely going to get sick. And I'm going to give you a play on that later. Now, we have Ford warns investors of an extra $1 billion in supply chain costs. And we see how Ford snuck in, raising their trucks like another $6,000 after electric cars got a $6,000 rebate. But we know Ford is definitely positioned for the fourth industrial revolution. Now, when we look at manipulating stocks, we know all about stock buybacks. And right now, tech is doing record-breaking buybacks. And we know instead of investing back in the company, growing the company, they're taking this money and buying their stock back so therefore they can manipulate it. We have Apple, we have Google, we have Amazon, and we have Nvidia. Now, when we look at Apple, everybody's looking at, hey, they're launching the Apple 14. We know everybody wants to get the new phone. But we know the masses are not looking at the geopolitical issues that are going on in the world. The fact is, the more and more tension we get with Russia, China, Taiwan, we know that Apple is going to get caught in the middle of it. Also, these chip stocks. Now, we know we have the holidays coming up. I'm not your financial advisor, not financial advice. Please do your own research. But we know Walmart is definitely going to benefit. We know Target is going to benefit because the wintertime is coming up and we know the flu is about to start. We have CVS and Walgreens, but I like CVS better. And then, of course, we know Google and Amazon. Now, the X factors are FedEx and UPS, and we had the FedEx CEO warn of a global recession. And we know these CEOs are coming out with the warnings because they want to get ahead of the game. They also know about the 15% tax next year. So they're getting ready to close stores, layoffs. And we know all the global corporations are getting prepared. But the number one sign that all these economies are going to be falling, if you look at the housing market, I don't care what country you go to, the housing market is taking a beating. And we have home builders lowering prices. And like I stated, right now we have absolutely no growth. So that means that we're going to be going through hyper-deflation. The Fed controls the supply and demand. And remember, they shrunk the supply during the C word, which helped housing prices go up, and especially rent prices got insane. Now, housing prices are about to come down, and rental properties are definitely about to come down. And with technology in a couple of years, we know real estate is going to be tokenized and put on blockchain. And then also we know machines will be building homes. Now, guys, let's get over into the actual indicators. We had yield rates slightly down. We had the dollar, which was slightly down. Anytime the dollar can come down, it's definitely going to help stocks and cryptos along with lower yield rates. And then plus the VIX was slightly down. But we know the VIX is going to start creeping back up just because we know Jerome is in the house. But guys, that's all I have for you. Have a wonderful day.
% increase. So, I think 1% would be better than 0.75% because there's more hiking to come, and they might as well just get it behind them.
Well, that's it. It feels, and you talked about this at the Milken conference with us on camera. We did some events, which is, it's like the Fed's going 100 miles an hour in a car on a wet road, and there's a wreck up ahead. They got to slow down.
Right.
But it feels like they're trying to slow down sort of all at once, but too slow at the same time.
Right.
How does this end?
Well look, this is going to end in tears.
For who?
For investors.
Us on this show?
Yeah, well, people that are long risk assets.
Hasn't it already? I mean, this year's been awful.
Oh, well, it can get a lot worse. I mean, I commented a couple of weeks ago that I thought we had another 20% to the downside in stocks by October. But, Brian, when you look at the stuff that policymakers should look at, the money supply is contracting. We have inflation that we're looking at in the rearview mirror. We're not looking at inflation going forward. There's a very good chance that in the attempt to prove their credibility that they're going to overdo it. And I think at some point here, as I said back in April, they're going to push it until something breaks. And I think the break will probably come through, equity prices, but could come in another place. It could come in the emerging markets. So, eventually this will end in tears. And one thing, with people that are talking about a stock market bottom, I would just point out one thing, and that is we have never had a bottom in a stock market without the Fed, while the Fed is still raising rates.
Never. Never had a bottom in the market while the Fed is still raising rates.
That's right. Raising rates, all of these things are only done by decreasing the supply of money. Money is like any other commodity. If there's more of it, it's cheaper. If there's less of it, it becomes more expensive. And so, the piece I wrote back in, I believe it was in January or February, which was, stop worrying about interest rates and, shrink the balance sheet and let the market find its equilibrium level. I think the Fed is pushing hard on the market at the same time it's shrinking the balance sheet. And we went through this before. I mean, it's amazing how short people's memories are. In the fourth quarter of 2018, the Fed was raising rates and shrinking the balance sheet. And at the December meeting, the chair Powell made the famous comment that, the balance sheet reduction was on autopilot. If anybody who was in the market remembers, we went down by 20%, and the next day the Fed was in the market pivoting and saying that the balance sheet mattered, and the Fed reversed course in the first quarter. The other argument here is that earnings are going to improve, and I don't see where that's coming from. Look at FedEx last week.
That was a one-off, though. I mean, UPS didn't warn DHL.
Right. No, but I'm just saying, there are more and more negative surprises coming out. It's not just FedEx. And, the energy, when you look at the growth in earnings that we got and how earnings have held up, most of it has come out of energy.
That's right.
And now we're going to give it back. So,